Hello everyone, I am Dr. Boraste from Department of Commerce at KTHM College Nasik. Today I am going to discuss with you the introductory part of piecemeal distribution of cash under the chapter piecemeal distribution of cash. In the last video, we have already discussed the syllabus of financial accounting, where the first chapter was accounting concept, convention, principles, and an overview of emerging trends in accounting. The second one was piecemeal distribution of cash. The third chapter was accounts from incomplete record, which is popularly known as single entry system. And the fourth one is introduction to goods and services tax, laws and accounting. Here we are going to start the second chapter, which is known as piecemeal distribution of cash instead of accounting concept and convention. After completion of this chapter, we will start our first chapter, which is theoretical chapter, and hence we are going to discuss with you later on. So, piecemeal distribution. What is piecemeal distribution of cash? As you know, when partnership firm goes into dissolution, at that time the partnership firm or partners have to pay all the liabilities. It may be a third party liability or internal liability. The preparation or the process is known as piecemeal distribution of cash. In this lecture, I am going to discuss with you the meaning of piecemeal distribution, then process of dissolution of partnership firm, then classification of liability. Later on, we will discuss on order of payment. Further, I will discuss on provisions of Indian Partnership Act 1932, methods of distribution of cash among the partners. In your syllabus, there is only one method, that is surplus capital method. Piecemeal distribution of cash. An introduction. What is piecemeal distribution? First of all, you must know the dissolution of partnership firm. Dissolution of partnership firm means winding up or closing up of a partnership firm. When the partnership firm is shut down, the position is called as dissolution of partnership firm. As per the Indian Partnership Act 1932, the dissolution may be either of partnership or a firm. Here, the dissolution of partnership amongst all the partners of a firm is called as dissolution of partnership firm. This definition or meaning is given in the Indian Partnership Act 1932. What is the exact meaning of dissolution? Dissolution of partnership firm is completely breakdown of the relation of partnership amongst all the partners. Means what? The basic rule of partnership is that for forming any kind of partnership, there must be at least 2 partners and maximum limit is 20 partners. If it is a banking business, the maximum limit is 10. So, whenever the relationship between that 2 or 20, whatever it may be, the relation completely break down, at that time, the partnership firm may be called as the firm is dissolved. When a partnership business comes to an end, the partnership firm is required to be dissolved. The assets are realized and the liabilities are paid off. Means what? Whenever partnership firm shut down or winding up or close up or shutter down, at that time all the assets should be sold in the market, and whatever amount you have been received from that sale of asset, you have to pay all the liabilities. So, since assets are realized in pieces, as you know, when if you want to sell the furniture or if you want to say a building which is owned by our partnership firm, at that time it take more time. It doesn't mean that when you want to say the asset at the same time it will be sold. So whenever you will be paid off that whenever you will try to sell the asset, you have to advertise it, then somebody will come to you and ask for that asset. That means, it simply means that assets are realized in pieces. Hence, the liabilities as well as the partner's capital are also paid in pieces. Means, if you want to sell your building for rupees 20,000 or 50,000 or whatever it may be, then you have a furniture, you have other assets, plants, land, whatever assets you have, when you sell that asset, you will get amount in step by step. Hence, you cannot pay all the liabilities in a single shot. So you can pay that you can pay that liability by selling the asset. That means it simply means you will receive the amount in pieces and you have to pay the amount, that is liability, in pieces. This method is known as piecemeal distribution of cash. Okay. Now, process of dissolution of partnership firm. On dissolution of partnership firm, the following process should be followed. What is the process? Assets are sold. That means process of selling of assets may take some time, as I earlier said in the last slide, that assets you have to sold in the market, then you will get the money, that is cash will be available in your hand. The assets are realized gradually and hence the liabilities are paid off in pieces. Available cash used to pay off the liabilities and capital of the partners as appropriate method. As I earlier discussed in your syllabus, there is only one method, that is surplus capital method, and whatever assets you sold in the market, you can get that money and you can pay off all the liabilities through the selling of assets. Which okay. Now classification of liabilities. Here the classification of liabilities is given. There are basic three types of liabilities, that is external, internal and capital accounts. External liabilities may include preferential liabilities and uh, other liability. So preferential liability may be government dues, say for example income tax or any kind of government taxes, workers or laborers dues, realization expenses, etc. Other liability may be a secured liability or unsecured liability. Internal liability means what? An liability which is related to your partnership firm internally. That means if you have taken a loan from partners, that is loan from partners, it may be called it is called as internal liabilities. And capital account, at the last step you can pay the capital accounts. Now the most important part of piecemeal distribution is that order of payment. What is order of payment? Order of payment means what? The person who is liable to receive money in a preferential way. So the person who have been given a loan or who have been given any kind of amount to us or creditors or whatever it may be, as per the government rule, there are certain liabilities which we have to pay first. Later on we can pay our partner's capital. So that is subclassified in preferential liability and other liability, internal liability and partner's capital. So first of all we have to pay preferential liabilities. So what is preferential liability? It may be a realization expenses. First of all you have to keep aside some amount for realization expenses. After payment of realization expenses you can pay government dues, then labor dues. Other liabilities may include secured liabilities, that may be a bank loan which is secured on any assets, and unsecured liabilities, it may be a creditor bills payable. If creditors are secure, at that time you have to cover that creditors in a secured liability. If creditors are unsecured, at that time you can include that liability as unsecured liability, it may be a creditors or bills payable. Then internal liability. Internal liability, as I earlier said, that internal liability may be a partner's loan. If any partners give a loan other than his capital amount, it is called as partner loan. That loan should be paid before, and at the end you can pay the partner's capital. As per the law, for example, surplus capital method, where if you followed, at that time you have to pay the amount to a particular partner who is given more capital to the partnership firm comparative to other partners. So this is the order of payment. Now I am going to discuss with you provision of Indian Partnership Act 1932. As you know, in India there is a Partnership Act which is enacted from 1932 and known as the Indian Partnership Act. As per Section 48 of the Indian Partnership Act, which describe the set of elements of partners accounts after dissolution of partnership firm. First one is losses including deficiencies of capital shall be adjusted first from the undistributed profits in the proportion of share profit. Then the assets of the firm will be paid off used by then outsider creditors, then advances from partners, balance of if any distributed in PSR. So these are some certain provisions which are under the Partnership Act 1932. Now we have to study the methods of distribution of cash among the partners. Basically there are two methods. First method is proportionate capital method and second one is maximum loss method. In your syllabus, in your first year BCom syllabus for semester 1, there is only one method, that is proportionate capital method. The proportionate capital method is known as surplus capital, as well as excess capital, as well as quotient method, as well as high relative capital method. So these are the nickname for proportionate capital method, and popularly this method is known as surplus capital method. The second one is maximum loss method, which is also known as notional loss method. But don't worry, it is not in your syllabus. In your syllabus, there is only one method, that is first method, which is known as surplus capital method. The word may be a excess capital method, quotient method, high relative capital method, or performance capital method, whatever it, sorry, proportion capital method, whatever it may be. You have to study only one method, that is surplus capital method. Now, I am going to discuss with you one simple example of surplus capital method. How to calculate surplus capital under the surplus capital method. Say for example, I am going to discuss you one simple example. You can take a pen and pencil, paper, and you can draw this small problem of surplus capital statement. So this is one example. Later on we will solve it. Following is the balance sheet of Messrs. A, B and C, where Mr. A, B and C share the profits and losses in the proportion of 3:2:1. Balance sheet as on 31st March 2020. So here balances of capital is given. Capital of A is 30,000, B's capital is 30,000, C's capital is 20,000. Total liability is 80,000. On the asset side, building is there 20,000, machinery 20,000, plant 20,000, other asset 20,000. Say the total is 80,000. Don't worry, it is a fictitious example. That's why I have taken a very simple example for your understanding of how to calculate surplus in a surplus capital method. If you have write down this problem or take a screenshot of this problem, now you can solve this problem by using my next slide. So this is the example of surplus capital. Now you have to calculate surplus capital. Okay. You have to draw a statement showing surplus capital, where you have to put 5 columns. First one is serial number, second one is particular, then A's capital, B's capital and C's capital. Or you can merge this column as a capital into next line. You can say A capital, B capital and C capital. Okay. Now first step is capital as per balance sheet. As you see in here, the capital of A, B and C is given 30, 30 and 20,000. So here you have to write down the capital balances as per the balance sheet, that is 30,000, 30,000 and 20,000. The second step is profit sharing ratio. In the last slide we have already seen the profit sharing ratio is 3:2:1. Third step is unit value or unit capital. Pay attention over here. What do you mean by unit value or unit capital? Unit value means what? If I am getting a share of 3, say for example we are discussing about A's capital. A paid the capital 30,000 for getting 3% or 3 ratio of in a profit. That means if there is a profit of rupees 3 plus 2 plus 1, if there is a profit of 6 rupees, in a 6 rupee Mr. A will get a 3 rupees. That means his share is 3, B's share is 2 and C's share is 1. That means it simply means for a 1 share Mr. C gives 20,000 as a capital. For 2 shares Mr. B is given 30,000 capital, and for number of 3 shares A given 30,000. That means for a single share Mr. A gives rupees 10,000. How you calculate? It is very simple. You have to divide the capital by profit sharing ratio. That means 30,000 divided by 3. So it comes to 10,000. 30,000 divided by 2, it comes to 15,000, and 20,000 divided by 1, it comes to 20,000. So this is the unit capital or unit value. Means for a single unit, how much capital is given by particular partner. So next step is proportionate capital. Here you can see 10,000 is in other color, while other are in a white color, and only 10,000 in a yellow color. Why it is? So I am going to discuss with you why it is in yellow color. So the next step is step number 4, that is proportionate capital. Proportionate capital means what? The person who is paid a less amount. Say here Mr. A is given 10,000, which is the unit value for 1 share. We have to calculate proportionately other partners capital. So 10,000 is our base. So we will consider 10,000 as base. Why it is 10,000 we consider base? It is less amount. Here 15,000, here 20,000. So 10,000 is a base capital. Now we can calculate proportionate capital. How we can calculate proportionate capital? There is a very simple formula. Base capital which have been assumed 10,000 into profit sharing ratio. That means 10,000 into 3, it comes to 30,000. 10,000 into 2, it comes to 20,000, and 10,000 into 1, it comes to 10,000. So here we calculate the proportionate capital by using or by considering the base capital 10,000 of Mr. A's and multiply by its profit sharing ratio. Now our next step, that is surplus capital. Surplus capital means what? Capital minus proportionate capital. Here I have given in bracket 1 minus 4. 1 means serial number 1, minus 4 means serial number 4. So 1 is surplus capital, that is 30,000 in case of A, and 4 means proportionate capital, that is in case of A is 30,000. So 30,000 minus 30,000 is come to 0, and 30,000 minus 20,000 is come to 10,000, and 20,000 minus 10,000 it comes to 10,000. It simply means that Mr. B and C given 10,000 as an extra capital compared to Mr. C. So 10,000 is the surplus capital. Now we have to calculate absolute surplus. Here we have calculated just surplus capital of B and C. Now we have to find out the single person or single partner who have paid more capital than other two partners. So all these steps will be repeated again. So next step will again, here profit sharing ratio, that is 3:2:1, but here already A's capital become a nil, that's why we are not considering A's capital. So only we are going to consider B's capital and C's capital. So B's share is 2 and C's share is 1. Now again we will repeat the same step, that is the unit capital, where the step is 3. Now at the 7th step we have to calculate the unit capital. As I earlier said, unit capital calculation is very simple. We have to divide that capital divided by profit sharing ratio. So 10,000 divided by 5 comes to 2,000. So sorry, 10,000 divided by 2 equals to 5,000, and 10,000 divided by 1 comes to 10,000. So again we will repeat the same step. Here I have given a yellow color to 5,000 because the base unit capital between B and C less amount is 5,000. So 5,000 will be considered as a base capital. Here you can see the base capital of base capital is rupees 5,000. We are going to consider 5,000 as a base capital, and 10,000 is a unit value of C. So next step is we can calculate proportionate capital. How we can calculate proportionate capital? It's a very simple, base capital into profit sharing ratio, as I earlier said in the previous steps, that is proportionate capital. So base is 5,000 into 2, that comes to 10,000, and 5,000 into 1, it's come to 5,000. The last step is absolute surplus capital. What is absolute surplus capital? Is nothing but 5 minus 8. That means here 5, the number row is 5 surplus capital. So 10,000. Next row is 8,000. So 8 is proportionate capital. The formula is very simple: surplus capital minus proportionate capital. Keep it in mind only one thing, that is surplus capital into proportionate capital, or here capital minus proportionate capital, and here surplus capital minus proportionate capital. So 10,000 minus 5,000, sorry, 10,000 minus 10,000, it will be 0, and 10,000 minus 5,000, so it comes to 5,000. That means it simply means the absolute surplus capital is 5,000. It simply means whenever we will pay the amount to the liability after the payment of third party liability, we can pay the amount of partner's capital. And first of all, we have to pay 5,000 to Mr. C because he have been paid an extra capital or surplus capital to the partnership firm. So we will pay off 5,000 to Mr. C. After the payment of 5,000 to Mr. C, then our next step will be 10,000 to B and 10,000 to C. But here again, once keep it in mind that about 10,000, we have already paid 5,000 here. So we will pay only 5,000 here. That means 10 plus 5. In this step, we have to pay 5,000. Just keep it in mind, we have to just calculate how to calculate this surplus capital. So here I have completed my simple example of statement showing surplus capital. So with this I would like to say thank you very much. In the next lecture we will see how to solve the actual example, how to calculate the surplus capital, and how to calculate the piecemeal distribution of cash and realization loss. Thank you. Thank you very much.